Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Weekly for Saturday, April 18th, 2020. And our top story today, public pension plans feel the pain. Joining me now to discuss this and a lot more is Keith Brainard. He is the Research Director for the National Association of State Retirement Administrators. Keith, thanks so much for joining us on the program this morning.
Good to be with you, Jeff.
It's good to see you. So let's talk about public pensions. Your organization represents many of the administrators of public pensions. What's the latest research, the latest information that you have from the organization, from your members, in terms of the status of public pensions?
Well, we're all living through some interesting times, and public pension plans are not accepted. Of course, public pension plans, along with all other investors, are going to be affected to some degree by the recent market events. We experienced a pretty sharp drop there in February and March, and have recovered some.
And when
affected by what states and cities are going through, which is an economic recession that most people believe that we are in, and that we would likely will be in the coming weeks and months. The reason an economic recession really affects public pension plans is that it typically impairs revenues for states and cities, and it makes it more difficult for states and cities to make their contributions to public pension plans. So sometimes in occasions like this, public pension plans get it both ways. The value of their assets can drop, which has happened a little bit recently. But in addition, their plan sponsors, the cities and states that sponsor these pension plans, can have difficulty making their required contributions.
Yeah, thanks, Keith. And, you know, my understanding, and just based on the research that I've seen from your organization, I think funding levels up to the point of the pandemic had actually been improving. And what I mean by funding levels is the difference between assets and liabilities. Would that be considered a true statement up until the pandemic?
Well, funding levels for the last few years have been holding about steady. But another way of looking at public pension funding has been the effort that has been made by employers to pay their required contributions. And that definitely is an area that has been improving. In a number of cases, California for its teachers, for example, New Jersey for just about all of its public employees, Pennsylvania, and some other cases that had a history of not paying their full required contribution have really been making improvements in the last 5 or 6 years, especially to make their full required contribution. Those New Jersey and California, for example, haven't gotten all the way there, but they've made it a long way. And that's one of the reasons I'm concerned about this recession, is that it may frustrate the ability of those and other places to continue to make progress on adequately funding their pension plans.
And it's certainly unfortunate. And at a time where we need our first responders, those are people in healthcare, those are people in the police and firefighters, right? I mean, these are people that are dependent on relying on these pension plans, in addition to other governmental workers. So it really just isn't a great time. But Keith, I mean, if we will get out of this, right? I mean, we're going to recover from this at some point. We might have to take a short step backwards, but over the long period, things I think were trending in the right direction, as you seem to be indicating, at least in terms of acknowledgement of the funding, except things like that. So over time, as the market returns and as things kind of return back to some level of normalcy, so too will portfolios, I would imagine.
Yeah. I mean, to some extent, we've seen this rodeo before. Markets go through cycles. Public pension funds are perhaps the ultimate long-term patient capital investors. These plans are in it for the long haul. They operate over decades. They invest with a 30, 50-year investment horizon. And that really positions them well to take advantage of opportunities like this, even though it can cause some short-term pain. It does provide some long-term opportunities.
Yeah, absolutely. And you mentioned we've seen the rodeo before. I love that analogy, by the way. And you are in Texas, so that's a perfect analogy. But 2008 financial crisis, other impediments in the market that we've seen and we've adapted to. And Keith, just to kind of put it in perspective for the audience, I mean, a lot of these pension funds have very solid cash positions. They have to in order to pay benefits. So there are retirees today getting paid out, and they will continue to receive their payments because pension funds maintain that cash buffer, that cash liquidity that is needed. Correct?
Oh yeah, these pension funds anticipate their cash flow requirements. They know or can project the amount that's going to be due and when, and they position their portfolios appropriately. And so they can project over the coming months and years how much of their portfolio will need to be in liquid form in order to meet their current benefit obligations. And so that allows these pension fund investors to set aside, the bulk of the portfolio into longer term investments, public equities, private equities, fixed income instruments, but then also to set aside a portion of it into cash and short-term bonds and more liquid investments in order to meet near-term obligations.
Yeah. And last question, Keith, and this is not really a research-related question, but I want to get your sense for this. And you are the research director, so you know a lot of things outside of just pensions. But in terms of like staying in touch with your membership, or business continuity. My understanding, and I was talking to Jim Potvin from the state of Georgia several weeks ago, right before this pandemic started, and he was putting into place, he and the executive team were putting into place ways to deal with business continuity and use technology. Is that your sense from many of the members, all your members at as part of the association? I would think that is happening state by state, or has happened state by state.
We surveyed our members a couple of weeks ago about how they were responding administratively to this pandemic and the stay home, stay safe orders that are pervasive around the country. And we were struck by the almost unanimous response that we received from our members, these retirement system directors, that all or virtually all of their staff, including investment staff and staff who are responsible for distributing benefits and auditing, benefits counseling, all of the facets of public retirement system operations were operating remotely, usually from home. And it really speaks to the technology and how that technology has advanced over the last 20, 30 years. I think already a lot of retirement systems, as well as many other employers outside of the public pension field, have introduced telecommuting for some of their employees. Pretty much all retirement systems have disaster recovery plans in place. And so they've been through this before, at least as a test case, if not in actuality. And so we really were impressed by the extent to which not only all of these retirement systems were operating completely remotely, but nobody was reporting meaningful snafus either. It was going seamlessly.
And I think that's a great way to end this segment. I think it's amazing, and I would consider those workers, those people who are they're on the front lines as well. They're essential. They are helping facilitate the benefits to many retirees, and also facilitating help for current workers as well who are on the front lines. So my hat's off to them. I applaud them. I think we applaud them. And Keith, I want to say thank you so much for making time out of your very busy schedule. You stay safe, and my best to you and the team over at NASRA.
Thanks, Jeff. Good to be with you, and you also.
Thanks, Keith. Great to see you. Stay safe, and we'll talk to you very soon. And when we come back, we'll take a look at our best segments for the week. You're not going to want to miss this, so stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. On Thursday, I sat down with Boston College's Center for Retirement Research, Matt Rutledge, to discuss his research on imports and older workers shifting to non-traditional jobs. Let's take a look.
The way we're defining non-traditional work, if you didn't see the first segment, we were talking about the fact that, it's hard to define independent contractor or gig economy job or contract firm employee. All that stuff I think is a little bit hard for people to answer. And so what we use instead is this idea that you have a job, but you don't get employer benefits for health or retirement from that employer. So that means, okay, well, then people are going to require, or probably, health insurance coverage. Where are they getting it from? Where are they getting the opportunity to save for retirement in a convenient and tax-preferred way? And so basically, we looked for those alternative sources of coverage for both health and retirement benefits, or health and retirement, health insurance and retirement benefits, just to see where else they could be potentially getting it from. And it's kind of a tale of 2 stories here. On the health side, they actually end up largely getting health benefits. Only about, well, I shouldn't say only, but about a third of people in these jobs that don't offer employer benefits do not have health insurance at all. So about a third are uninsured. But a lot of them are able to get insurance through employers. Those employers, though, happen to be their spouse's employers. Or a former employer, either retiree health benefits or COBRA coverage that you can get for the first couple of years, the first year and a half after you leave your job. And so they're able to sort of piece together those alternative pieces of health insurance coverage so that they aren't completely out of pocket on all health care that they might get. Also, public benefits actually really are important. I think what we are finding is that the states that adopted the Medicaid expansion and that started running their own health insurance marketplace for the individual plans saw greater increases in coverage rates than the states that opted not to expand Medicaid or just use the federal exchange for the individual plans. And so the workers in those states just had more options available to them and were less likely to be uninsured. On the retirement side, actually, it was a little bit more difficult for people to find an alternative to the 401ks that they might have gotten from other employers. Spouses don't seem like they save more in their 401ks if they're married to a non-traditional worker. So that means that the spouses aren't really, as a family level, they're not making up for the lack of retirement savings that people might have lost out on because of the lack of a 401k. And people just don't save in IRAs. That's something that people tend to use IRAs just as a rollover. It's basically their past 401ks. They don't tend to save directly into IRAs because it's a lot harder to do. You have to do a lot more work yourself. You don't necessarily get matching contributions to be able to build up your savings in a faster way. There's not somebody holding your hand to actually get you to make sure that's done. And so, at least on the health side, I think people are largely going to be able to find alternatives. But on the retirement savings side, I think people are really at risk of falling behind if they're working in these non-traditional jobs. And that's something where a lot of state policies or federal policies could do a lot better job. It's always a challenge to get people who are already fairly far along in their careers, who can see retirement on the horizon, to make sure that they have enough resources to be saving for retirement. Even in a 401k world, you have that much less time to be able to build up that savings to allow it to appreciate, to be able to sort of deal with the ups and downs that we've seen over the course of this year in the stock market, for sure. The catch-up contributions in 401ks and in IRAs are a great way to actually allow for more people to save. But in point of fact that, especially in 401ks, most people aren't maxing out their 401k before they're 50. They probably can't afford to do so after they're 50 either. So catch-up contributions probably aren't the answer. That's something that's mostly going to benefit higher income people. IRAs, it's a little bit easier to max out what your contribution would be on a tax-deferred basis. And so those catch-up contributions, I think, are a little bit more helpful in IRAs, where I think you're maxing out at something like $7,000 now, and you could potentially go to a couple more thousand, I think, with the catch-up contributions. So that's something that could actually be helping people in their 50s. There's definitely some possibilities that the Social Security system could potentially be more generous. It could be especially helping people at the bottom, where there's more progressivity of benefits, a greater encouragement in offering retirement plans to make sure that people are taking responsibility and saving for themselves, pushing people to retire later into making sure that they actually have those jobs available to them, is something that you can't beat that in terms, like, there's no savings rate. The savings rate to be able to be comparable to just delaying retirement by a year or two, it would be off the charts, nothing that anybody's going to be able to hit. And so I think there's no easy answer to making sure that people are prepared for retirement. It's kind of a patchwork is really needed. All of the above is the way that we should be approaching retirement security. We may have gotten a little complacent with almost 10 years of job growth, just sort of assuming that there would always be more jobs available, opportunities to stay in the workforce, opportunities to feel comfortable enough to actually contribute to that 401k or to the IRA. I think we're seeing a reminder that recessions happen, and sometimes recessions happen quite suddenly. And 2 months ago, we seemed like we were quite comfortable, that things were just hopping along, and now that's definitely not the case. I mean, I think right now our primary concern is just to make sure everybody's actually healthy. I think the very older workers that we're concerned about, or those mature workers, to use your terminology, might also have chronic conditions that might make them very vulnerable to, in the short term, not necessarily getting through this pandemic or getting through this in a productive and healthy way. But then once we're past that, I think it's going to be really worth thinking about our safety nets, making sure that people actually aren't feeling the full consequences of the risk that they may be facing in the job market, in the stock market, making sure that they have something to fall back on in case the timing of their retirement, the timing of their health decline, the timing of their spouse's health decline, the timing of their grandkids being born and them wanting to be part of that it's not so vulnerable to the downturns that they might see in the market. I think making sure that we have, a good unemployment insurance benefits, a nice easy cushion for people to potentially leave the workforce more gradually if they would like to. All of that, I think, is going to be very important. And unfortunately, we're in for a tough couple of years, and that's if we're lucky. And if it's more like the Great Recession, it might be more like a tough 5 years or so. So let's hope it's more of that V-shaped recovery than the long checkmark shape that we just saw.
And on Monday, I sit down with S&P Dow Jones Indices Mona Naqvi to talk about environmental, social, and governance funds. Let's take a look.
I think it's helpful to kind of talk about where different investment products are heading. And as an index provider, we can, I can certainly speak to where interest in different types of indices is coming from. Sure. So we talked a little bit earlier about different thematic SRI style investment strategies, where you screen out certain types of sin stocks from the index or the portfolio, be it tobacco or fossil fuel free. And those strategies have been around for a very long time. And actually, they're very successful. There is still a huge degree of appetite for those types of strategies. But what's changed and what's kind of newer to the market is more core ESG integration, where we are seeing different types of strategies catering to the broad market sort of benchmark exposure you would typically expect from our mainstay beta indices, but with a kind of ESG version or kind of a boost to overall ESG performance without necessarily having to give very much up in terms of tracking error and returns. So with that, last year, we launched our flagship new S&P ESG index series, including the S&P 500 ESG. There's several products tied to this in the market, both across Europe and North America, and it's been incredibly successful. And the reason for that is because it's giving investors the opportunity to align their values with their investments. The index methodology in terms of the 500 ESG gives you around a 25% boost in ESG score, while at the same time, very closely tracking the underlying parent S&P 500 with less than 75 basis points of tracking error and almost identical risk and return. In fact, over the past 1 year, in the last 3 months of volatility in particular, we've seen that these indices have actually outperformed the parent S&P 500, which is an interesting tidbit, although that's not the objective of these types of products. But needless to say, it's a compelling new tool for investors and pension beneficiaries to look at options for getting in the ESG game without necessarily having to give up the things that they care about in terms of return. What we've seen in particular, driven by the pension fund and endowment space, has been a lot of noise and action on the divestment type of approaches. And that's usually come from directly, in the case of student and university endowments and the like, from the end pension beneficiaries or the endowment beneficiaries or the students that care about these issues. And for them, sometimes we see it sort of a moral expression that they don't want to be funding activities that aren't aligned with their values. And so that's a space where the kind of SRI style strategies is still very successful. But the key thing that you said that's interesting to me is actually to what extent are these asset ESG flavors and actually targeting returns that are kind of relative to those instead. And that's something that I think will be the next stage of adoption. So far, we've seen a lot of peripheral allocations to ESG, and these new types of tools like the S&P 500 ESG index that offer a core substitution from the traditional beta benchmarks are helping us get along that path towards a point where ultimately we will switch, I hope, the kind of market benchmarks and tools to the ESG versions, make those the benchmarks against which we measure and track and evaluate performance. And then we'll really start to move the needle in terms of influencing company behavior towards more sustainable practices. I've often said, if you had two identical portfolios that gave you nearly the same returns and levels of risk, but one made the world a better place, it's kind of a no-brainer which one most people would choose. So I think that's key. But you also raise an interesting point that the whole investing ecosystem and the value chain is not just down to any one player. It's an ecosystem of different groups. And actually, coming back to the asset owners, I actually, to their credit, particularly the asset owners in Europe, we have them, the industry, I think, has them to thank for in terms of driving and catalyzing so much of the interest in ESG, with many of the Nordic and other European public pension funds, for example, that have been the ones to mandate that their managers have to incorporate ESG in their investment practices, at least show a process for considering whether or not it's material. And that has really kind of trickled down into a broader ecosystem, be it asset managers, be it investment consultants or index providers like ourselves, that are kind of meeting their demand. So really, I think that the time is now, momentum is greater than it's ever been before, and all actors are kind of lining up to help move the ball on ESG.
And that wraps up this episode of BRN Weekly. But as you know, we're not done for the week, because tomorrow we've got our podcast, BRN Sunday, where I'll be joined by members of the media, academia, and financial services to to analyze all the news for the week in retirement, markets, technology, personal finance, and so much more. You're not going to want to miss this show, and we've got another very special guest. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.